with the coalition victory, it essentially means that Labor's policies, particularly around franking, have disappeared. And this is a positive impact on retirees who can now invest with more confidence and who are at risk of potentially losing up to 30% of their income under Labor's proposal. So, we think this is bullish for the stock market. There was evidence that investors were sitting on the sidelines, and as I said, this now enables them to invest with more confidence. And we also saw some evidence that investors were switching out of those high dividend, high franking stocks into alternatives like REITs and infrastructure and offshore equities. So, we think it's a good opportunity for retirees to look at Australian equity income strategies focused on delivering a growing dollar income with after-tax benefits, particularly when you think about where alternatives are at the moment and the likelihood of RBA cutting rates even further. Well, we think retirees will focus on those high dividend, high franking paying stocks. Banks and Telstra are the obvious names that will get looked at. But we caution investors that you need to ensure that you're focusing on business fundamentals and not making investment decisions based purely on tax. Well, with the re-election of the coalition, Labor's negative gearing changes are effectively off the table. And that's positive for the outlook on housing. In addition, APRA has proposed changes to guidelines around assessing mortgage serviceability for lenders. And again, that's supportive for housing. So that big bear investment thesis for banks has basically been largely removed. Now, that said, the outlook for banks is still not overly rosy. Still plenty of headwinds facing the sector: low credit growth, competition intensifying, margin compression, bad debts increasing. So despite the attractiveness of dividend yields in the banks, we're happy to have a small underweight positioning to that sector with NAB, our preferred exposure. Plenty of other alternatives that we're seeing in the market right now. Well, Telstra has almost been a staple in most retiree share portfolios, despite the fact that its capital has halved and its dividend has halved over the last couple of years. We recently used share price strength to exit our small position in Telstra. We simply felt that a 4% dividend yield with very little growth was just not a reasonable risk-return proposition. I think the market has viewed the ACCC decision to not allow the Vodafone and TPG merger to proceed as being positive for mobile competition and Telstra in particular. However, our view is that it's been Optus that's been driving discounting in that space, and we just simply haven't seen any sign that has been abating. In addition, Telstra still has significant execution risk around its cost out strategy and its product simplification strategy. So, in our view, we're seeing plenty of other opportunities for stocks that have a reasonable dividend yield with franking benefits. Well, the recent lockup of stock as investors have tendered their shares into the off-market buyback and awaited the allocation essentially resulted in an elevated share price in our view. The stock reached a PE of around 23 times and representing a dividend yield of around 3%. So we use that share price strength to reduce our exposure to Woolworths. It's been a core portfolio holding for us over the last couple of years as the management team has successfully executed on their strategy. And look, it's a quality name, and we expect the share price will probably moderate following the buyback, and we'll look for opportunities to re-enter that name. Well, our portfolio is focused on growing dollar income above inflation over time. So we're looking for companies that can deliver an attractive dividend profile, both in terms of yield and growth and after-tax benefits, but also importantly, valuation support. And we're seeing a number of names out there, stocks like Flight Centre, Suncorp, Super Retail, Tabcorp, IPH, Star Entertainment Group. These are all good, solid, quality companies that have a very a clear dividend profile over the next 3, 4, 5 years, and that's where our portfolio is focused right now.